Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the energy complex for Thursday, August 18th. But because of the tight correlation currently between a number of commodity sectors and especially the energy complex to the S&P market or the equity markets in general, we're going to start off with coverage of the S&P E-Mini due to especially some important developments overnight. Starting off here with a daily log scale bar chart. And out of deference to the extent and impulsiveness of the July-August follow-up to the broader peaking and reversal threat that developed in April, May, and June, we have been advising traders to approach the past week and a half's recovery attempt as a corrective event within what could be a much broader debilitating decline in the S&Ps. And indeed, you can see by this daily chart on a log scale perspective, yesterday's 1207 high is virtually the 50% retrace of the July-August sell-off from 1354 to 1077. That retrace cutting across at 1208. Now, in and of itself, we never rely totally on such derived Fibonacci relationships in the absence of a confirmed bearish divergence in momentum, but as we'll discuss in a minute, we have one overnight sufficiently to define yesterday's 1207 high as one of developing importance. If we move to a daily close-only basis on a linear scale, you can see of this latest portion what we suspect is a smaller degree third wave decline from the 21 July high at 1342, that high close, to the recent 1111 low daily close on August 8th. The 38.2% retracement cuts across at 1200, the figure. And the high daily close on August 15th was 1198.50, virtually on an exact 38.2% retrace. And around such a combination of levels like this 1200 level on a close-only basis and the 1208 level on an intraday basis, we want to be particularly watchful for any bearish divergence in momentum needed to stem that intermediate term uptrend and define a more reliable high and resistance from which resumed bearish policy can be very objectively based. And if you look here on a 4-hourly chart, you can see yesterday's and overnight's failure below an 1177 corrective low from the 16th. From Tuesday, that confirms a bearish divergence in short-term momentum. And while that is only of a short-term scale, the importance of it is a very important byproduct is the definition of yesterday's 1206.75 high. We're going to call it 1207 as a much more reliable high from which bearish exposure can be objectively based, with tight protective buy stops just above that 1207 high. And in fact, we have advised a new bearish or resumed bearish policy and new bearish exposure on that break below 1177, so traders should be short with a 1207 stop. It's also interesting to point out in this suspected bear market correction that if it is merely corrective, it should unfold in a labored three-wave pattern. It's interesting to note that this 1206.75 high came within 2 points of the 100% progression relationship that made the suspected C wave of this bear market correction from 1103 the same length of the 100% progression of the preceding 1077 to 1179 A wave recovery. So we've got a lot of things cutting across in here that were activated by this confirmed bearish divergence in momentum that exposes further and possibly steep losses that could span weeks or even months. These factors considered, traders are advised to maintain a bearish policy in general in the S&P contract and indeed very likely all the equity markets around the world, with a new bearish exposure on the break below 1177 advised to be protected with a 1207 buy stop. And until or unless that high is taken out, we don't want to underestimate the extent to which this market could now get bludgeoned. Now, moving to the September crude oil market, and pretty much as we've been recording this webcast, the market has broke the 85.62 corrective low from Tuesday that confirms a bearish divergence in momentum. That defines the 89, the figure high from yesterday, as one of developing importance and quite possibly the end of the past week and a half's bear market corrective recovery. You can see here on a daily bar chart basis on a logarithmic scale the prospect that the major bear trend remains down, with that former support from late June around the 89 handle area now considered new resistance if this market is still truly weak. And by virtue of this confirmed bearish divergence in momentum, we now have a very specific objective level from which to rebase a bearish policy. You can see here on a daily log close only basis the possibility, the bullish possibility, that all the price action down from the April 29th high close up at 113.93 is just a three-wave and thus bull market corrective sequence. We don't want to try to outguess what this mid-August recovery it is. It might be the first wave recovery of a much broader base and reversal environment. But given the likelihood that the broader bear trend is still down, we don't want to underestimate the equally bearish prospect that this recent recovery is merely corrective ahead of what would then be potentially very steep losses straight away. Per this confirmation and bearish divergence on a short-term basis, traders are advised to move from what was a neutral to cautiously constructive view following a bullish divergence mid last week to a neutral to cautiously bearish policy now, with strength above 89 the figure required to negate that and expose a larger degree reversal higher. In lieu of such strength above 89 the figure, the market, we believe, is vulnerable to further and possibly excessive, even relentless losses in the weeks and maybe even months ahead. Moving to the RBOB contract on a daily close-only basis, you can see the recent mid-August recovery and confirmation of a bullish divergence in daily momentum above the daily high close at 280.52 from August 5th. But this recovery thus far is insufficient to confirm a larger degree reversal higher. And in that regard, we must allow for the prospect that this is merely bear market corrective ahead of a resumption of the 3.5-month bear trend that could get quite ugly below that 266.76 low close from August 9th. Moving here to a daily bar chart on a logarithmic scale, you can see yesterday's high at 292.68, just a stone's throw away from the 293.61 level. That is the 61.8% retrace of the July-August sell-off from 317.5 down to 258.70. And what's of a key development here overnight is the developing potential for a bearish divergence in momentum, just similar to that just got confirmed in the crude oil market. And in this regard, Tuesday's 282.89 corrective low will be a short-term but pivotal one today that, if broken, will confirm this divergence. And the important byproduct of that is that it will define yesterday's 292.68 high as the end of this recovery. Again, we don't know. We're not going to assume we know whether this is a bear market correction or the first wave, part of a first wave of a major move higher. But following such a bearish divergence in momentum, that until or unless that 292.68 high is taken out, we don't want to underestimate the broader bearish count that this recent recovery over the past week is merely corrective ahead of what then would be sharp sustained losses in the weeks ahead. These issues considered, traders are advised to move from a neutral to cautiously bullish policy to a neutral to cautiously bearish one if the market breaks below the 282.89 level, again, that we believe could expose steep losses straight away. And finally, moving to the September heating oil contract, you can see a similar developing bearish divergence potential on an intraday basis, but the market needs to break below that 290.72 corrective low from Tuesday to confirm that divergence. But we would caution traders to understand yesterday's rejection of a $3 exactly high. A little bit above that level is the 61.8% retrace of the sharp early August decline from 319.55 down to 270.20 on a linear basis. If you move to a daily log scale perspective, 292.72 is the 61.8% retrace of the 319.55 to 270.20 decline. So we want to be particularly watchful for any kind of momentum failure from this Fibonacci retrace that might resurrect the broader slide from the April high up at 333. And we believe specifically that that 290.72 level, if broken, will confirm that and re-expose that broader bear trend and what could be very steep, relentless losses in the weeks ahead. These issues considered, traders are advised to maintain a neutral to cautiously bullish policy until the market breaks below 290.72, and if it does, we advise traders to move to a neutral to cautiously bearish one in order to participate in what could be a sharp, relentless resumption of the broader sell-off from the April high way up at 333. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.